Hello and welcome back, guys. In this video we are gonna be doing something that a lot of people have been asking me about. We're gonna be building a $100,000 stock portfolio from scratch pretty much. So I'm gonna show you which stocks I have selected here, the reasons behind these. We're gonna be using our tool to analyze, and we're gonna be also buying the stock in a virtual account that I have made for this purpose, which we can also revisit sometime later in later videos. So let's start and see how this is going to go. Obviously, disclaimer here, all the stock suggestions and the picks that I'm basically doing here for the video are not meant to actually provide any financial advice for you. It's mostly for entertaining purposes, obviously, and you shouldn't be treating these as financial advice. And so let's move on. The main goal of this portfolio, because obviously every portfolio can have different reasons for its existence. Some portfolios could be potentially growth-based portfolios, other ones could be dividend-based portfolios. This one is sort of like a long-term portfolio that is aiming to acquire some solid performing companies that are trading at cheap valuations and hold them through the years. We're going to use our tool here at myinvestorsheaven.com for analyzing stocks, of course, and patrons can get full access to this tool and also get this full PowerPoint that I'm using in this video. Of course, you will find all the links in the description box below this video, and you can visit them and pretty much download everything that you want. Please, by the way, if you are new around here, subscribe. I would love to have you around. And if you're watching this, leave a like as well. This video took many hours to make. And so if you want to leave a like, that's heavily appreciated because that really helps. Okay, so what are the goals and restrictions of this portfolio? We're going to be going about 80% United States, USA stocks, and about 20% of China, a little bit less actually. And some companies are going to be non-Chinese and non-US companies as well, just a few. But overall, they're going to be trading in the US stock exchanges or China. And in terms of diversification, I'm not really going for pretty much including every industry out there, but mostly including the best companies that I could get. So you may be looking at some industries that are not really very well represented in this portfolio. But again, the idea here is to buy good companies and not just buy companies for the sake of owning a whole sector. That's not the point. In terms of allocation, I will have a 5% max allocation for any single stock. Now, I won't be going more than 5% for any of our stocks that I'm going to be using, I'm going to be buying, and the minimum holding is going to be 2%. And in terms of dividends, I'm not aiming for dividends in this specific portfolio. But of course, as you can understand, a lot of good companies do pay some dividends, in some situations, even good dividends. And so, unavoidably, you will be getting some dividends from this stock portfolio. And I will be having at most 6 fully allocated stocks. I will actually have less than 6, but this is my goals here, my restrictions. I will never be going more than 6 stocks of 5% each. Pretty much saying here that there won't be 6 stocks holding 30% of my portfolio. In terms of allocation percentages, they are structured in many ways potentially, like you can use, for example, market cap, lots of different things. In this case here, I base my percentages on the valuation that I'm seeing, and how much of the company I really want to hold based on what they have been doing financially and based on the valuation that I'm seeing in front of me. And some other factors as well that I'm going to be explaining per company as we're going through this video. Okay, the overall company operations, that is. Okay, let's move on. First one, the first holding here that we're going to be taking a look at is going to be Google or Alphabet. That's ticker symbol GOOG with a 5% allocation for this portfolio. And now I'm having some reasons why this is going to be our first company here. And down below at the very bottom of the video, you can find some potentially negative reasons as well. Now, this is obviously not going to be a picture that will tell you everything about the company because we're having like 30 companies in this video, but you can get a fair idea of what is going on with this company. It is a company that is trading at a less than 20 price to free cash flow NPE over here. The company had record growth pretty much last year, so it's still growing quite a lot. In terms of cash flow, it's generating tons of free cash flow. It's buying back shares and it has little debt as well, so very easily manageable debt here. In terms of margins, the company's main revenue is advertising, as we know about, which is obviously a high margin business. They're making pretty strong margins there. And they have a strong moat, meaning that it's a company that is not easy to replicate. It can't be having too many competitors around. Some issues here: TikTok competition and microeconomic conditions, obviously. Facing some strong competition from TikTok, for example, YouTube is adjusting via creating shorts and monetizing shorts that we have talked about recently. Current economic conditions could impact the business margins as well in the short term. Now, what we are going to be doing is we're going to be jumping to our pretty much web browser here, in which you are seeing that I'm having a portfolio which is currently empty over here, and we're going to be pretty much filling it in live as the market is currently ongoing. And so the first thing that we're going to be doing is I want to go through our tool that is myinvestorshaven.com, and I want us to examine just very quickly what the company is doing and what the valuation would be for that company. So let's take a little bit of a first look at Google. So we did talk about the valuation metrics of Google, which you can kind of see here. Pretty nice PE, pretty nice price to free cash flow. I'm not going to be talking about the same things that I talked about in the previous slide, but I will take you to our stock evaluation tool here in our tool, and you will see that I have already filled in the projections here at an 8, 10, and 12 estimate, net income margins and free cash flow margins. Obviously, and of course, you can basically become a patron and get access to our tool and try all sorts of valuations of your own, because you may be having some different ideas about how Google is going to be growing through the next 5 years. And so in this case, you're looking at the company being evaluated pretty much at a medium, at our medium estimates here, with a green, with a pass over here, and anything above that is fine. And it's only our low estimates here where the company is still a little bit red. But again, you can imagine that it has a lot to do with valuation, with the projections that we are having here. And also, we need to be taking into account all the other great things about the company, taking it to a point where it's actually a pretty solid buy over here. It's going to be the first 5% allocated to my portfolio. So let's go back and do that in our eToro account over here. And so what we're going to do is I'm going to go to search and I'm going to type GOOG. And you will see that we're getting Alphabet here, and I'm going to go trade. And so we're taking a 5% over here out of a $100,000 portfolio. So this is 5%, as you'll see here. Now, I do like to go with units instead. So I do want to get like exact units. So let's go 50. It's going to be a little bit less, but I think it's going to be a little bit better. I don't want to have fractional shares. Although you could have, and you may eventually get some, especially if you have a dividend reinvestment program, you will eventually get some fractional shares. But for the sake of this video, I'm just going to go with pretty much whole numbers, so 50 over here. And what I'm going to do is I'm going to open a trade over here. And so you will see that the order was immediately filled. Again, this is a virtual portfolio over here. And you will see that the total invested amount is for about $4,900. It's not going to be exact again, but we're going to be at around where we'd like it to be, around 5%. So let's move on to our second one. What is going to be our second addition in our portfolio? So my second addition here, my second selection is Meta, or Facebook, with a 5% allocation as well. Because of its very cheap valuation, it's trading at a near 10 price to free cash flow and PE ratio. And the company is still growing at a great pace for its pretty massive size, generating tons of free cash flow, has almost no debt, and it's still buying back a ton of shares, and they're going to keep buying shares. They have pretty high margins as well as Google, that is, because of advertising being its core business. Strong mode too. Not many competitors that can compete at a similar level of Meta's advertising media. And another thing that may not be thought about a lot is the fact that that Meta's advertising is very, very targeted, pretty much generating traffic from, for instance, groups, which are very, very targeted people, pretty much. There are very targeted groups of people there. So it's much, much easier for advertisers to advertise rather than actually having like TikToks or shorts where it's like about entertainment. You can have things like about, let's just say, scuba diving or fishing or anything of that sort. It's very, very allocated, very, very targeted. In terms of the metaverse risk, that's a big thing. The company has been spending a ton of money. The metaverse is costing the company billions right now, and we don't know of its success. Is it going to be a successful story? So there's a risk there. And the company is also facing some competition pressure from the likes of TikTok as well. Interesting to see, but what about the valuations of the company? Let's go take a look using our tool again now. Now, Meta has been down a lot, way too much, like 60%, and you will see the things that we talked about already. But what we're going to do is jump to our stock evaluation tool, for which I have already set the projections here. Obviously, again, you can use our tool and have your own projections, but you will see that with these projections over here, we're getting a solid green everywhere, really, with our current price being at 140. So very, very solidly green here, and a nice purchase. It's going to be the second edition of my generated portfolio. So let's go back to our eToro account over here, and let's just buy Meta here. So what we're going to do is go Meta, and we're going to trade Meta over here. Again, we're getting 5% of that. It's going to be about 36 units, so I'm going to go units. Let's do 36. And let's just open a trade over here. Again, you will see that the exposure is about $4,900, and that is making a ton of sense for purchasing. Okay, let's do that. Open trade, and you will see that our order was filled, and Meta is actually now another stock in our portfolio. And if you take a look at our portfolio over here now, you'll see that we already have Meta and Google, which is what we basically just bought. Cool. Let's move on to our next holding here, to our next stock that we're going to be buying. The third stock in our portfolio is going to be the first Chinese one. It's going to be Alibaba, with another 5% allocation for the overall portfolio. Because of its very cheap valuation, again, the company is trading at an insanely low 9.4 price to free cash flow over here. And you can see that it's still growing a ton, 40 billion in revenue in fiscal year 2018, while 134 billion in revenue in fiscal year 2022. And you can see right below that in terms of its balance, it's a similar story, growing from 69 to 170 billion. It's generating tons of free cash flow, very little debt that the company has, and easily manageable that is. And upcoming stock buybacks, the company has already announced those. A huge business too, is one of the world's largest companies, and it's trading at jaw-dropping valuations. Chinese governance, supply chain issues, lockdowns, and lower margins are the things that have been plaguing Alibaba. The Chinese government crackdown here, the supply chain and lockdown issues from COVID. The margins of the company have also been hurt quite significantly recently. This is why their most recent quarter has been pretty bad due to investment issues, competition issues, probably some temporary slowdown for Alibaba. And so this is why the company has really suffered recently. But again, let's go back to our stock evaluation tool and see what kind of valuation we're getting for this company, for Alibaba. Now again, over here you can kind of see that the company's P ratio is high because the company had issues with its net income recently, but the price to free cash flow is rather low. And if we take it to our stock evaluation tool, you will see that I have again already filled in everything, and I'm getting a reasonable and comfortable green as well, with a low of 106 using these specific projections that I'm using over here. So Baba is going to be our third one in our portfolio. And so let's move on to our fourth one. What is the fourth one going to be? But before we do that, I forgot that we need to be taking a look at our portfolio here and actually buy the company. That's important. So let's go Baba over here, and we're going to be trading it again. We're buying 5%, which is about 63 units. So we're taking it 2 units over here. And this is about 4,900. We open up the trade, and you will see that we just bought about $5,000 off Alibaba as well. Okay, so let's move on. Let's jump to the fourth stock that we're going to be buying for this portfolio over here. Intel is going to be my fourth stock over here, with a lower allocation because of its relative risk, although I do feel that the company is going to be doing rather well. Oops, I actually moved on to the next one. But yeah, you will see that I'm taking a little bit of a lower allocation over here, about 3%, because the company's valuation is insanely cheap over here, sitting at a 6 in terms of its PE, amazingly low for a company like Intel. And the company's net margins are still rather high. The operating cash flow that the company generates is still quite a lot, but they do have high capital expenditures. They are expanding a ton recently. The company is so cheap as well that Intel is actually buying back shares, and it's a huge business too, one of the world's most known blue chips pretty much. Now, the company is growing less than its past, and it's shadowed by some competition from the likes of AMD, for instance. And so its dividends extract cash flow as well that could be used for growth otherwise. And so the company is paying a nice dividend, but the problem is that using this dividend and paying this dividend could actually be an issue for the company, and especially for people who are looking to be buying this for a growth story, which I would. But or at least a company that continues to grow because it's still a pretty large company. But the fact that they are actually extracting quite a lot of dividends is one of the reasons why I'm allocating 3% here. Otherwise, I would potentially go a little bit more because I don't really like this kind of business paying that much money back to shareholders. This is not the type of business that should be paying back dividends, frankly. But okay, I will still going to be adding about $3,000 in my portfolio. So let's go back to our tool as usual and see what kind of valuation we're getting here for Intel. You can very quickly see the amazing key metrics here for Intel, but I'm obviously going to be jumping to our stock evaluation tool, and you will see that again we are very, very comfortably in the green over here. The company has lost a ton of its value, and even with a 0% revenue growth, this is still an easy green over here. The company growing not at all, not growing zero, at a zero pace, 0%. For the next 5 years, you're still getting a very, very comfortable buy over here. Its current price is super low. Compared to what the company is generating in free cash flow, that's basically a no-brainer. It's a company that I would definitely be adding to a long-term portfolio. Okay, let's move on and actually buy the company again. We're going back to our eToro over here, and we're going to be buying Intel here. It's the next one. And so what we're doing is trading. This is going to be 3,000, remember? So I'm going to type 3,000 here just to see the amount of shares, about 111. I'm going to convert to units now. And I'm going to be buying 111 shares of Intel over here. I'm going to open up the trade, and this order has already been fulfilled as well. Okay, let's move on and move on to our next pretty much stock, the fifth one in our portfolio. Okay, let's go back. Well, I accidentally betrayed that already earlier. This is going to be Adobe. And I was a little bit hesitant about this one because it's not very cheap. As you will see in the red over here, it's still a little bit expensive, but it's not that expensive. It's a little bit more expensive than some people would like, and it makes a ton of sense. But there are so many positives here that could account for a slightly more lucrative valuation. And you will see that the company is trading at a relatively normal valuation. What I mentioned, maybe slightly expensive, of course, as I mentioned already. The company, though, has amazing net margins here, and it's generating tons of free cash flow. It's buying back a lot of shares as well, and has very little debt, a very solvent company here. And it's also very tough to compete against, like its subscription models and its products. Very, very tough for competitors to enter this space. And so I really like Adobe over here, and this is why I'm having a 3% allocation of this company. Again, I'm not going too overboard with this because it is a company that is not too cheap, but I do want to get a little bit of it, frankly. And so this is what I'm going to be doing next for my fifth stock, which is going to be Adobe. So let's go back to our tool and examine this stock valuation as well, as usual, as we're doing with the other ones. You can kind of quickly see that the P ratio is a little bit high here for Adobe, but they have been buying back shares. The price to free cash flow is fair. And if you take a look at our stock evaluation tool here for Adobe, you will see that we are very close to our medium projections being green. They're still red. The company's current price is 284. So some people could potentially maybe wait for 250, 230 or something of that sort. The high is 310. But frankly, because the company has been doing that well and their margins are amazing, they are generating very good free cash flow, I am potentially willing to pay a little bit more and allocate 3% of my portfolio just for holding this company for the long run. So I think this one is going to be my fifth one, again with a little bit of a less allocation, a 3%. We're going to go back to our eToro here, and I'm going to be buying Adobe. So I'm going here, and Adobe is going to be my next one. Again, this is going to be a $3,000 because it's a 3%, and the units are about 11 here. I'm going to go 11 instead of 10. So we're going to average it upwards, and we're going to be opening the trade over here. And Adobe is going to be the next one that we are currently owning. You can see our whole portfolio again over here. We have already invested about $20,000 over here. Okay, let's move on to the next one now. So back to China. Tencent is going to be the sixth one with a 5% allocation as well. It's going to be another large Chinese holding. A very cheap valuation as well, near 13 to 14 are the multiples. The company net margins are high. It's generating good free cash flow as well. It has a very good return on equity too, without holding a lot of debt, which is a very nice thing to see too. And the company is also very solvent, little and manageable debt. It has a slightly high dividend payout. The company is paying some dividend here, as you'll see, a lucrative dividend actually that is more than 50% of its produced free cash flow. Typically, when it's more than 50%, it's a little bit, potentially a little bit problematic because it extracts a lot of the available cash flow that the company generates. And at some point, if it reaches too high, if the company's free cash flow gets less and less and less, maybe they will have trouble paying that dividend and they will have to cut down on that. So there is a little bit of risk because of this one, which is about 60%, as you will see next in our tool, which we're going to move on to right now. And we are here with Tencent. You will see what I was talking about. The ratios are fairly nice over here. The company is doing nice in terms of growth, but you will see that the dividends that they are paying are rather high, about 62 and 64 in terms of the payout ratios, which is a little bit much, is the problem. But let's take a look at the valuation as well, the actual price to pay for the company. You will see that our valuations here for Tencent are looking very nice, very solid, 36, 47, and 62 based on these projections. Fairly solid here, a super simple buy that I am definitely willing to add to a portfolio. So Tencent is going to be my next holding. And let's go back to our eToro here and add the TCEHY. And, oops, this found a person actually. So Tencent, and that should be the one, and trade this one. And let me actually, yeah, this is, let me verify that actually. Yeah, they seem to be having the Hong Kong shares over here instead of the actual, I think it's over-the-counter stock for Tencent. So I'm not seeing it here. Let me type it again, Tencent. Yeah, I'm not seeing it over here. And if I attempt to be buying it from here, I think the markets are closed. It's not going to go through. I can try it. So let's just try that. This would be 5%. So it's going to be 138 units. We can just leave it open potentially again, and it will go through when the market's open. And we're going to go set order. Again, it was a 5%. That should be fine. And I believe, yeah, this is going to be received, but it's not going to go through. No big deal. But yeah, because the whole idea is still the same thing. Okay, let's move on to the next one. After Tencent, what is the next company that we're going to be buying here? So playing a little bit of defense with the next one, this is going to be a defensive play, a play that has a lot to do with the current economic environment, and you know, it's all about the dividends pretty much. It's an income-based company alone, and that's pretty much the only reason. It will take a 3% allocation in our portfolio, and its valuation is rather cheap, which again can be potentially normal for this kind of industry, of course. The company has been also buying back some stock. Bad thing about this one is it has a relatively high debt, it has low margins and low growth. It's a behemoth, it's a company that is not really growing. It's a company that pays you dividends, that's what it is. So if you are looking to have a relatively solid, or pretty solid I should say, income-based company, Walgreens is a good one to own here. And again, this is why this is added in this portfolio. Now, of course, again, I'm not going high on dividends, but you know, to have a complete portfolio, it's worthwhile having at least one or two companies that are paying some good dividends overall. And this is what I'm going to be having here, among all these other companies that are going to be growth-based and all sorts of different things that you're going to be seeing down the line. So let's go back to our tool and see what's going on with Walgreens over here. Again, Walgreens is not a company that you are buying for growth, but it is a company that has been going down in terms of its stock price, yielding relatively nice ratios over here, and it's still paying a very solid and very easy to pay dividend, about 5.8% in the last 12 months, and I believe it's actually higher right now based on its current stock price. So that's pretty fair over here and pretty nice. But what about its valuation? Let's go and take a look at its valuation level. And as you will see here, this is Walgreens again. This is not a super cheap company again, but it is a company that is going to be paying a solid dividend, and it's not expensive either. And so with this kind of pretty conservative valuations here, we are still in the green. It's only a low one with a 1% revenue growth, and it's still in the red. But again, you're buying this one for potentially getting some high dividends. And if we take a look at the dividends tab as well, you will see that we are looking at about 6% dividend for a company that has been paying dividends for a long time now. So again, a defensive play here for a portfolio that requires a little bit of extra income potentially as well. I mean, why not have some income at least? Okay, so let's go back to our next one, which is going to be a little bit of a similar story here. Okay. I'm always forgetting to be buying too. So let's actually go here first and buy Walgreens. Walgreens is going to be 3% of our portfolio. So we're going to go 3%, which is about 92 units. So let's go 92 and open the trade. And so now we also bought, did it go through? I'm not sure. I think it didn't. Okay, it did now. So the order was filled here for WBA as well. So let's move on to our next stock, the next stock in our portfolio. So the next one is going to be Target, ticker symbol TGT, with a 2% allocation this time, a little bit less, because I don't want to go overboard with this kind of defensive companies. But again, it's still nice to have some allocation of these. A fair valuation of a 17 PE and 13 price to free cash flow, maybe slightly expensive, and still growing. The company is huge, but it's still growing rather well. A very safe and nice dividend here. Good return on equity, but with some debt. So that's always there's always a catch there. Share buybacks. The company is also being buying back stock. As I mentioned, it's still a little expensive. Its dividend is not very high as well. It is, however, pretty safe in terms of its payout. So it should be easily able to pay its dividend for decades. So if you are looking for a little bit of extra dividend income and a steady company, this may be a nice one to add to a portfolio that's looking to be gaining over the years. To be gaining some value over the years from a lot of different sources, whether income-based or growth-based, that is. So let's go back to our tool. And so we are looking at Target here, which you'll see it's pretty much solidly green almost everywhere, a little bit of extra debt. But you'll see that the dividend yield is 2.4% in the last 12 months, a 34% free cash flow payout ratio. And if you take a look at the dividend stub, you will see here that it's 5.9 based on the current stock price. So that's actually pretty neat. Okay, so the next thing that we're going to be doing is take a look at our pretty much stock evaluation tool, and you will see that I have already filled it in, and we are getting pretty much again almost green everywhere, and it's only our revenue growth of 3% that is still in the red. Again, this is a company that you buy for the income. It's not a company that you're expecting to grow too much over the years, and it's still a little bit expensive. It's a defensive play that can actually yield you some income through the years. Okay, let's go back to the next one. Apologies, I just noted that I accidentally was using Walgreens, the previous screen here. So the dividend is actually 2.5% over here. And if we take a look at our dividend stub, you will see that through the years it's 2.9 actually. So yeah, I was accidentally looking at Walgreens before, no big deal. But let's go back to our eToro. It's still a pretty nice dividend actually. So if we go back to our eToro, we will allocate 3% for our 2%, that is, for our target acquisition here. So target, and we're gonna go 2% over here, so 2000. This is 13 units. I'm gonna go 14. It's close to 14. Let's go 14, and this is going to be almost 2000. So let's open the trade and buy target as well, and move on to the next stock in our portfolio. Moving on to our next one, the ninth in our pretty much portfolio, is going to be Best Buy, a retailer here with a 4% allocation in my portfolio. A very cheap valuation here, trading at a 9 PE and a 6 price to free cash flow. Even though it's still a growing company and it's growing big, it is growing at a steady but kind of low pace. This big here is a mistake. Actually, it's a typo. It's actually growing at a steady but rather low pace. Safe dividend, safe and high dividend. That is a high dividend that is safe in terms of its payout. Good return on equity, but with some debt. The company has also been buying back shares. Macroeconomic conditions are some of the issues here that can hurt retailers. The company has been doing very well overall, but it can be temporarily hurt by the current macroeconomic conditions, which you can of course understand right here. And this can actually lead to potentially lower growth and some suppressed margins for a company of this sort, already having rather low margins. So these are some concerns for a company like Best Buy. You will see here that the company is been buying back shares like made maniacs, and their dividend is amazing as well. Pretty nice over here. In terms of our valuation, you will see that Best Buy over here is solidly green as well, with a 91 being pretty much our lowest in terms of our projections, with a -1 in terms of revenue growth, actually, with actually losing revenue. The company is still a solid buy here, a very solid buy actually, with its current price being at 68, which is giving me a lot of conviction about this company. This is why I'm going to be allocating 4% of my portfolio for Best Buy. So let's go to our eToro here, and we're going to go BBY, which is Best Buy. Do not actually confuse that with Best Buy with Bed Bath & Beyond. That could be a very important mistake, because the ticker symbols are similar. But 4,000 is the actual allocation. 60 units, 60.3. I always like to go a little bit more. Let's just go 61. And that's the units that we're going to go with, 61. And this means about $4,000. So let's open the trade for Best Buy. Our portfolio is already up. That's good. Okay. So the order has been filled. So let's move on to the next stock. NetEase is going to be our next Chinese holding here with a 5% portfolio allocation as well. A fair valuation trading at a near 20 PE and 15 price to free cash flow. A company that is growing a lot. It has dropped significantly lately, giving us a nice entry point here for a Chinese company. A dividend that is safe as well in terms of its payout. Good margins, very high margins actually for a company of this sort. The company has been buying back shares as well. Of course, the Chinese crackdowns, the overall economy problems, potential problems for any Chinese company right now. There is some risk with China. We do know about this one, but I think it's going to be resolved in the upcoming months or maybe a year or two. We'll see about that. But the thing is, NetEase is definitely going to be the 10th stock in my portfolio. Let's go back and examine the company in a little bit more detail using our tool. For NetEase, as you'll see here, everything is in the green. The company is paying some very nice dividends as well. So things are looking very nice over here for the company, which is still growing rather nicely too, with nice net income margins. And what about the valuation? NetEase over here, you will see that we are still in the green solidly. It's only our low ones which are a little bit off with an 8% revenue growth, but still I'm happy with buying this one at this level and to hold it for some time. So NetEase is going to be one of the holdings that I'm going to be adding for my Chinese allocation. I want to have some Chinese companies here, so this is why I wanted to add NetEase as well to this portfolio. Of course, in your case, you could add any stocks that you want, of course, but you may want with much less China too, in case it scares you. But yeah, for this one, we're going to be adding NetEase, and this is NTES. I hope I can buy this one now. This may be an ADR, I'm not sure actually. Let's take a look at our eToro. NTES, NetEase, and trade. This looks like an ADR, yeah, US market. And this is going to be a 5% portfolio allocation. So we're going to go with 64 units of stock. I always make this mistake with $1, 64. And we're going to go and open up in NetEase position over here. And yeah, this is going to be the next one in our portfolio. Let's move on to the next stock now. 3M is the next company in our portfolio with a 3% allocation because of some of its risks, but I still wanted to get a little bit of 3M. A cheap valuation trading at a near 15 PE and 10 price to free cash flow. A company that has a good return on equity, a high and safe dividend, historically safe as well. With share buybacks too, the company has been buying back shares. They have some lawsuit issues for which we have extensively talked about in our Discord channel. Feel free to join us, by the way, if you enjoy these kinds of discussions. We are there pretty much every day. And a rather high dividend payout ratio, as you will see here. The company has been paying a large portion of its earnings in dividends. So let's examine that in a little bit more detail. And we're looking at 3M over here, which again is pretty much solidly green. And you will see that the company has a little bit of debt over here, but it's paying a very aggressive dividend over here, again historically safe, with a free cash flow payout ratio of about 58%, slightly high, but probably safe for the next few years, for the next decade or so at least. It should be fine. And let's take a little bit of a look at our stock evaluation tool, and you will see that again this is solidly green over here, with our even our lowest estimate still being in the green for 3M. So there are some risks here, but I think it's a company that I would like to hold in our portfolio. Pretty solid company with a very high dividend payout, payout pretty much. A little bit of a higher ratio too, but I'm willing to take this kind of risk to add some nice income to a portfolio. So this is going to be the next one. Let's move on to the next company actually, to our next holding here, to our next stock position. But first, of course, buy 3M. It's going to be a 3% in our portfolio. So 3M over here, MMM, and we're going to invest, and $3,000 is going to be a 3% in our portfolio. We're going to go with 27 here, 27 units. Whoops, 27, and we're going to open the trade. And did it go through? I'm not sure. I didn't see anything. Let's do it again. Okay, hopefully I'm not buying it twice. Let's take a look at our portfolio. So 3M, no, it's 27 over here. So it looks fair. Okay, yeah, hopefully I didn't click twice on any of these. We'll see in the end, I suppose. So let's go back to our next holding here. What's going to be the next holding in our portfolio? Probably a surprising one to many. I want to add a little bit of GoPro here with a 3%. A riskier one. This is a higher risk company, obviously, But there are some very nice things about it, and I do like to add some potential growth to a portfolio as well. Again, this is going to be a riskier one. It's not for everyone, but it's trading at a low, at a very, very low PE, a 2 and a 3 in terms of its free price to free cash flow. Good returns on equity, low debt, good margins here. The company has been adding subscription models as well. It's getting better and better, and I like to see that. The company has been buying back some shares too. It's a high risk one. It relies on its subscription model to become a company that's going to be making money through the years and making sustainable sources of income. But I think I want to add a little bit of this portfolio of this company in my portfolio, especially as it's now sitting at about $5. I think it's going to be a company that I'm going to be adding like 3% of and see how it goes, how that goes through the years. So let's go back to our tool. As you will see here in our tool, the company again is solidly green in most areas over here. They have been actually issuing some extra shares for sure, but their margins, for instance, have been getting much, much better, and the company is becoming more and more profitable here, which I love to see. And if we take a look at our valuation tool, you will see that we are solidly and very, very easily in the green over here, with relatively normal revenue growth here, while the company did amazingly last year. I think this is still under the radar of many people, and so this is why I would like to add it to my portfolio with a 3% pretty much holding of my total portfolio. And I'm gonna go back to eToro, and I'm gonna go Gopro, and this is going to be a company for which I'm gonna be allocating $3,000, and I'm gonna go about 597 units, 597. I'm gonna open the trade. This never works the first time, I suppose, for some reason. So the order received, and it should go through. I'm not sure why it hasn't gone through yet, but yeah, it's still pending for some reason. But okay, this is going to be the next stock in our portfolio, and we're moving on to our very next one right now. Etsy, the next one in our list, Etsy Corporation. A 3% allocation here for a company that is trading at a 19 price to free cash flow, but a higher PE near 34. Some adjustments to the free cash flow that cause a lower price to free cash flow. So the company is not too cheap. You have to bear that in mind. Good return on equity. The company is achieving good return on equity, but with some significant debt, which always helps the return on equity typically. The company is achieving good net margins as well and has great revenue growth, which is one of the core reasons why I like this one. Now, as you'll see, the company has quite some outstanding debt, and its stock it's not that cheap, even though it has been down significantly since its last year high, and that always helps a little bit with taking a decision of this sort. So let's go back to our tool and see what this company is about and what its current valuation should be. So Etsy over here, it has been down significantly, and you will see that some metrics are not the best that we'd like them to be, but they are not terrible as well. So it is a little bit more expensive than what we'd like for its price to earnings ratio, but it's down significantly since it's 1 year high or so. And the company is doing very well and has been growing tremendously well as well. And if we take a look at our evaluation tool here, you will see that it's only our initial estimates with a revenue growth of 18%. Again, the company is growing at great pace in 18, 20, and 22. You will see that analyst estimates are near these levels, actually. So this is not far from happening, frankly. And the company is sitting at a rate here for its low estimates and its medium and high are green. But I think it's a potentially solid addition. These kinds of companies may not get too cheap, so it may be worthwhile paying a little bit more for their growth and paying a little bit more for their margins. It's a company that's doing great. Always a little bit riskier to be buying at a little bit more expensive price, but it's not that expensive, and I'm willing to pay a little bit more for quality always. As long as it's a quality company growing in a nice way, I'm always willing to pay a little bit more. It's not always buying the cheapest thing, it's also buying a thing that is relatively fairly priced or maybe slightly expensive, but it's good. So in this case, I'm going to be adding Etsy to my portfolio, and I believe it was a 3% allocation. So let's go back and add this to our portfolio. So back to our eToro here, and we're going to be adding Etsy. I'm going to be trading $3,000, and this is going to be about 32 units of stock. So 32 units of stock over here. I'm always actually trading on the I'm always averaging it up, so eventually I hope I will have enough money to be buying the last ones. So let's open the trade here, about $3,000, open trade, and this has been filled as well. Let's move on to the next one. Smith & Wesson, another relatively defensive one, although way more cyclical in nature. Smith & Wesson is a company that's trading at a very low PE as well, and the price to free cash flow 4 and 4. The company is still growing overall, not much, of course. It's a high dividend too, that is safe in terms of its payout. Good margins for the company, rather high. Share buybacks as well. And a cyclical company, it's a company that will be going up and down quite a lot. It's cyclical in nature, so it can have quite some ups and downs through the years. It helps that it's paying a dividend though. So let's take a look at our evaluation page. So we're looking at Smith & Wesson over here, which you'll see mostly in the green. There have been some free cash flow issues here with the company in the last few years, so this is why we're getting the company at a cheaper price too. So the company hasn't been doing as well, but remember it's cyclical in nature, and this is why it's down quite significantly over here. And it's actually made a typo there. The price to free cash flow is not 4. I think I forgot to change that. It's it's negative because the company has been losing some free cash flow lately. And overall, I think it's still an interesting buy. The company's payout ratio is still rather good. And remember, it's the free cash flow that is showing in the negative here. So they're paying a 3.4 in terms of a dividend payout. So if you take a little bit of a closer look at the cash flow statement for Smith & Wesson, you will see that it has been suffering a little bit in terms of its operating cash flow, and then it goes down in terms of its free cash flow when adjusted for the capital expenditures. So over the last few quarters, it has been in the negative as well, and this is why you're looking at an overall bad picture in terms of its free cash flow. But again, this can be and will likely be a sort of like cyclical thing, which is not going to be last for a long time. You'll see that we're in the negative right now, but just mildly in the negative for the quarter, which is deeply affecting, of course, the overall picture. But still, I think that SWBI is a company that would be nice to hold for the long term. If you take a look, for instance, at its balance sheet over here, you will see that the total equity of the company is sitting at similar levels, up and down quite a lot, because, again, a cyclical nature, a company that has cyclical nature here. And overall, it is one that is increasing its retained earnings. It's a small company that I feel an investor can do well potentially by holding for a few years. But again, if you take a look at our metrics page, you will see here that it's trading at a very, very nice valuation here, and it's still increasing its gains. It has little debt and pays some nice and easy to pay dividends here for the company. Payout ratios are very low. So I like to see that, and it's a company that I would like to add to my portfolio at this valuation, especially after it's down 58%. I think it's a nice addition to a portfolio. So SWBI is going to be a $3,000 one, so we're going to add a little bit of this one here in our overall portfolio. I'm going to go SWBI, and I'm going to trade this, and I'm going to be adding $3,000. So $3,000 is about 297 units is what we saw. So 297, and we're going to open the trade, and this is received and filled as well. Let's move on to our next stock. Next one is going to be American Express, or AXP, with a 4% allocation. A rather cheap valuation, sitting at 14 PE and 7 price to free cash flow. A company that is growing overall, though not much, of course. Again, it's a very, very big company. Low but safe dividend. It's something that's nice to have. This is not really a dividend company per se. Good margins here, is achieving respectable net margins, share buybacks for the company, and inflationary hedge too. It's a company that can keep on doing well in an inflationary environment. One of the reasons why I'm having a 4% allocation. A company is handling debt, credit, of course, and you are going to be seeing some high levels of debt. So let's take a look at our stock evaluation tool. I think I may have missed also showing you the Smith & Wesson stock evaluation tool calculation here, which for a -10 in terms of its revenue growth, it's still in the green, by the way. So in case I missed that, I think I did. You can just quickly take a look at this one before we move on to American Express next. So over here for American Express, you can see that what we talked about, the company buying back shares, has a little bit of debt as expected. And over here, you will see that it's paying a pretty easy to pay dividend. And if you take a look at our valuation page, you will see that it's for the most part solidly in the green. It's only our lowest estimates here that are still red. But overall, I think this is a nice addition to a portfolio. I'm going to be adding 4% on our eToro over here of American Express. So let's go AXP, and it's going to be about a $4,000 one, 4%. And it's going to be 29. This time I'm going to go 29. And I'm going to open the trade, AXP. Okay, this is done as well. Let's move on to the next one. Inmode is going to be a 3% allocation in our portfolio, another riskier one, a growth story over here. A cheap valuation, trading at a near 15 PE and 13 price to free cash flow, a company that is growing a ton. a growth company, that is, a company that still has low levels of debt, a high return on equity with low levels of debt, and high margins too, very high actually. A company that has a bad thing about dilution here. The company has been issuing tons of shares, like a lot of shares for funding themselves, significantly diluting previous shareholders. This is something that you don't really like to see. But overall, the company is a nice addition, and I think I'm going to be taking a little bit of a risk in that by adding a 3% allocation in my portfolio. So is Inmode over here that you can see, and again what we talked about, the outstanding shares have been increasing a lot, but take a look at these key metrics here and growth of the company looking very solid and nice over here. And if we take a look at our stock evaluation tool, you will see that Inmode over here sitting at 27 bucks. It has a very high net income margin, and you will see that with these valuations here, with these projections I should say, we're still in the green for every price over here. So even if they achieve a little bit less, we're probably still going to be in the green. So it's a company that I'm going to be adding some to my portfolio Inmode, that is. And let's actually add it here. Inmode, 3,000 bucks is going to be the amount that we're going to be adding here. Not 33,000, 3,000. And this is going to be 110 units. So 110. Cool. Let's open the trade, and Inmode is also added to our portfolio. Okay, so we have allocated quite some. We have about $40,000 available. So let's move on to our next stock. Next one is going to be Qualcomm with a 3% allocation. It's trading at a near 10 PE and 15 price to free cash flow. A very well known and big company which is still growing. It's paying a rather high but safe dividend as well, and is achieving very high net margins. Stock buybacks too for the company, buying back shares like crazy. It's significantly dropping its equity because of this buyback. So the company has been buying back tons of shares, dropping their total equity and artificially inflating their return on equity ratio. This could potentially actually increase its price even, if some investors flock in because of this return on equity. It hasn't been seen yet, but it could happen. So it may be an interesting allocation, an interesting addition here to the portfolio. And this is one of the reasons why I'm going to be adding it here among the others, which we're going to examine using our tool. And so we're taking a look at Qualcomm here, and you will see that pretty much again everything is solidly in the green, with the company buying back tons of shares over here, dropping their equity is what I told you about earlier. And their company is paying 2.4 in terms of its effective, that's the last 12-month dividend yield, with a very easy to pay dividend over here. And if you take a look at our evaluation tool, you will see that we are in the green. It's only our 6% revenue growth, which on average the company has been doing actually 8.6 that is, and actually last year they did 42. So the company is still growing a ton, and it's solidly a solid buy here again. So this is a company that I'm going to be adding to my portfolio with a 3% allocation too. And so we're going to go back to our eToro. That is QCOM, is Qualcomm. And I'm going to go trade, and I'm going to be buying $3,000 over here. I'm going to go units, and this is going to be 20, what was it, 20, I believe that was 25, right? Yeah, 25, pretty much. And we're going to do this trade as well. Cool. So the next one is already there. That's Qualcomm. And let's move on to the next stock in our portfolio. We're going to be doing a little bit of banking with the next couple of stocks. That's going to be Goldman Sachs, the next one. 3% allocation, it's trading at a near 7 PE. Now, it's much tougher to analyze bank companies. I have made dedicated videos about this. You're going to be seeing weird free cash flow, for example. Growing company, it's paying a high and safe dividend, high margins, it's buying back shares like crazy too. It has a low price to book ratio, which is very important for like banks, very important. It's sitting at 0.89, which is good for a financial services company. It's a credit company. Rising inflation environment can potentially affect it, but I think I want to be adding a 3% allocation to my portfolio. And let's take a look at what this company is about using our tool as usual. You can see Goldman Sachs here. Of course, we cannot really be taking a closer look at the price to free cash flow ratio or the free cash flow, pretty much, because it is a bank and the free cash flow doesn't work the same way as with the normal companies. And this is why you're looking at an important metric here, like the price to book ratio, which is fairly low. And again, you can be taking a look at this one. This makes more sense over here, but the company is paying a nice dividend, and its equity to book is pretty nice over here. Its price to book, that is. And yeah, it's a company that I'm going to be adding to my portfolio. Of course, we cannot use our stock evaluation tool here, again, because this is going to be heavily skewed, because heavily affected by the free cash flow, and so we cannot get an accurate picture by examining free cash flow for banks. So let's move on to our next one. And before we do that, of course, we're going to be buying Goldman Sachs. Again, GS over here. And we're going to trade this one, $3,000 valuation. and that's 10 units. I'm gonna go 10 for this one. Again, these are banks, generally speaking, a little bit riskier, but if you can get them at a low price to book, it's an interesting idea potentially. So open trade, of course, you're gonna be buying well-known banks too, by the way, and banks that are doing well financially. That goes without saying. Okay, so let's go back to our next one, to what the next addition to our portfolio is going to be after Goldman Sachs. Is going to be another bank with another 3% in our portfolio. It's going to be HSBC. I like this one because it had a very, very low price to book of 0.55 over here. It's trading at near 8 PE. The company is paying a high but safe dividend in terms of its margins, also high net margins too. Again, a credit company, rising inflation, almost no growth too. That's a concern for HSBC. It's not really growing, but it's paying a nice dividend, and it's a very, very low price to book ratio company. So this is why I wanted to add this to my portfolio. Again, it doesn't make a ton of sense to be taking a look at the free cash flow, at the discounted cash flow model here for this one, because it is a bank, so we're not going to be doing that. What I'm going to be doing is I will buy the 3% and I will move on to the next one, for which we can actually much more normally utilize our discounted cash flow model. So for HSBC, we're going to be adding a 3% allocation to our portfolio next. As usual, I'm here on eToro, so HSBC, oops, if I could type, HSBC that is, and we're going to be adding a $3,000 addition. 112 units is what we're going to be doing. So 112, and this is about $3,000. So we open this up, and this is filled as well. Let's move on to the next stock. Footlocker is going to be the next one with a 3% allocation, a retailer that we're going to be adding. It's cheap, trading at a 7 and 7 in terms of PE and price to free cash flow. The company has some debt, but it's not much. Is also paying a high dividend. Again, this is mostly a dividend company that has also been bust lately. Stock buybacks too, buying back shares like crazy. It's a retailer, which is risky in the current macroeconomic environment. And we also know about some Nike issues with the company not being able to sell this. Now, again, this is a company that you are buying for it being down a lot, and also because it's paying a nice and safe dividend. Let's take a look at it. You can see Footlocker here. It's very low in terms of its PE and price to free cash flow, has been buying back shares like crazy, has a little bit of debt. It's paying a solid and hefty dividend over here. And in terms of its valuation, you will see that it's solidly in the green, even with a 0% revenue growth here. So it's still pretty solidly and easily in the green for this company. And this is where I'm going to be adding to my portfolio. I'm going to be adding this one. And it's going to be a $3,000 allocation for Footlocker FL, that is. And we're going to go $3,000 for this one, which is about 87 units of stock. So let's go 87 and let's open the trade. And this is done too. Let's move on to our next stock. Getting a little bit spicy now with Micron Technology, Semiconductors here, trading at a 5 PE and a 22 price to free cash flow. Company that is growing, of course, and it's paying a rather low but safe dividend. High margins, very high, and reasonable debt. The company is a cash-hungry business, but still the debt levels are pretty reasonable here. Supply chain, of course, demand issues for semiconductors, can be some issues with Micron and all the other semiconductors company, but they have dropped so much in terms of their stock price that I think it may be an interesting allocation, and I'm going to be adding 3% of Micron next. This is obviously not the cheapest company that you could get, and you will see it in the free cash flow. Pretty obviously, the company is paying a ton in capital expenditures, but you will see over here that the company is paying a fairly solid and a small dividend overall. But if you also take a look at our valuation over here, you will see that we are in the green for our medium and high estimates for Micron. Again, it's not going to be super cheap, but it may be a company that you can add to a portfolio right now and feel good about it. With these valuations over here, I think it makes sense to be adding a little bit of Micron. I'm going to be doing this right now, and I'm going to go MU and add $3,000 to my portfolio, which is 61 units of stock. And I'm going to be buying Micron too, and move on to the next addition in my portfolio. Staying at a similar space, we're going to be adding some TSM, Taiwan Semiconductors, with a 3% allocation. An interesting valuation. It has a low PE of 15, but a 39 of price to free cash flow. Again, similar story, high capital expenditures. A company that is still growing a ton. The company that is paying a respectable and safe dividend. The company is also achieving very high net margins. Has reasonable amounts of debt. Again, cash hungry, and huge moat. And the reason for this is that the company has some very, very proprietary I should say, inventions really that it's using for chips, and it's almost impossible for other companies to mimic. So not many can compete. The company is also facing some supply chain and overall demand issues, of course, but we're going to be adding 3% of TSM in our portfolio. Now, TSM is a company that will look like it's way more expensive than it actually is, and that's because of the capital expenditures. It's because the company is not really converting its free cash flow to actual free cash flow, but rather using it for its operations. And so you will see that the company is still growing very nicely and is paying a dividend that has a payout ratio of 33%. Again, you can't be taking too much of a look at the free cash flow ratio here because these companies are actually sending a lot of money towards their capital expenditures, and this will be affecting our stock evaluation tool. And if I'm using something like what the company has been doing, like 60, 70, and 80, we are still in the red over here. But if I go with something that is more normalized, something that's more what is going to be happening when the company stops spending all this free cash flow to capital expenditures, you will see that we're getting a far better picture here. And even these medium estimates over here are basically sitting at the current price. So this is looking at like a much better picture with revenue growth of even 8%, while the company has been achieving significantly better revenue growths in the past. So I think still I would like to add a little bit of a TSM in my portfolio, even though it's also a little bit more expensive. I think it's value, and I would like to add it to my portfolio right now. So I'm going to be adding 3% over here. Let's move on to our eToro, TSM that is, and $3,000. So TSM, Taiwan Semiconductors, $3,000, and this is going to be 41 units. It was almost exact before it dropped a little bit. And so we're going to open the trade over here and buy TSM2. And just a few stocks remaining. Let's move on to the next one. Maybe a little bit of an unexpected one, right? Zoom Video. It has dropped a lot and somehow it's still in Cathy Wood's portfolio, but actually it's getting interesting and has a near 23 PE and 15 price to free cash flow. Company has been abandoned. It has had a lot of growth and then it dropped precipitously. And this may be the time where I actually get a little bit of it. 3% that is. Fast growing company, growing a ton, little debt, great margins, very high margins. It's been diluting shareholders, understandably so, because the price of the stock was insanely high. This probably is unlikely to continue, of course, because it has dropped tremendously since its highs. So let's take a look at it. That's Zoom Video. A situation. Oops, that's the wrong one, sorry. So this is the correct one. A situation in which Zoom Video has dropped 74% and it's sitting at $74 rather than almost $300. And you will see here in our stock evaluation tool that it's getting to buy territory. And our medium and high estimates here are already green, and even our low ones are almost sitting at the current price of the stock. So this one is a buy for me, and I'm going to be adding it to my portfolio. Again, some very nice things to see here for the company. Take a look at this growth over here. Again, we talked about the issuance of common stock, which has been happening, but we are expecting it to decline. And you're already seeing it decline because the stock has dropped. And of course, the board is not going to be issuing shares forever, obviously. Great margins too. So I like the company over here. I'm going to be buying $3,000 of Zoom. ZM that is, and $3,000. So $3,000 here of ZM, and 40 units, 41. That is, we're going to go buy 41. Open the trade and move on to our next stock. Thomas Rowe Price, one of my favorite ones, frankly, a 4% allocation for my portfolio because it's very cheap, a 10 PE and a 7 price to free cash flow, a solid company that is still growing, little debt, great margins, high but safe dividend, everything really. The company buying back shares too. The only bad thing, there has been some issuance of stock pretty much here when the stock price was high. However, since it's been down a lot recently, about 70% down, it is unlikely this will continue, is what I'm saying over here. As I'm reading this, I'm actually realizing that this was pasted from the previous slide. So please scratch this one. This is not correct. The company hasn't been diluting shareholders. It has been buying back shares. So yeah, this is a mistake. Apologies for that, but don't pay attention to this one. There hasn't been dilution, and you will see it in our tool next. So yeah, you can kind of see it over here. There hasn't been dilution. The company has been buying back shares. It's been so many stocks and so much time today that I have spent on this that I made a little bit of a mistake. But you will see that the company's financials are looking solid and great over here. Very nice dividend, hefty one actually, and great payout ratios here. And if you take a look at our stock evaluation tool, again, very, very nice projections here. So I love this company, frankly. And this is going to be one that I'm going to be adding 4% of to my portfolio. It's going to be TROW price. And we're going to be trading this one $4,000 over here. This is about 37 stock, 37 units of stock that is. And we're going to be buying 37. Open the trade and be done with it and move on to the next one. This is a play that has to do with energy, which generally speaking I'm not too fond of, but I do realize that at the current market it may be worthwhile to add a little bit. Still, I'm going to be adding one that has to do with income for the most part. 8 PE and a 3 price to free cash flow, a very low, cheap valuation, a high dividend paying company, a reasonable debt, and high and safe dividend, that is. Stock dilution that has been happening, diluting shareholders like crazy, but an interesting addition to an income-based portfolio, and this is what I'm aiming to achieve with this one, pretty much having a reasonable 3% in my portfolio. So let's take a look at this one. So this is a company that I'm adding solidly for the dividend, and because it is an oil and gas midstream company, a very big one as well. And you will see some bad things, the fact that the company has been issuing tons of shares, of course, and still the company is growing nicely. And two things that I want to see in these kinds of companies: I don't want them to have insane amounts of debt. The company will have some debt. It's a gas company after all. It doesn't have insane amounts of debt though, and it has a very reasonable, it's actually very high dividend yield over here and very reasonable payout ratio. So these couple of things is what I want to be getting out of these companies. And again, with energy and oil, you have to be super careful because they can go down on a moment's notice. But taking a little bit of an advantage of the current situation, it may be an interesting potential situation of actually getting a little bit of a dividend back. And we're going to be taking a look at our stock evaluation tool here and see whether it's what kind of valuation the company has right now. It's almost impossible to predict what these companies are going to be doing in the long run. So a DCF can actually lead you to results that could happen or could not happen because, again, these companies are very cyclical in nature. But if you use reasonable estimates, you are still getting a green all over the place. So this is a company that I am willing to add a little bit of in my portfolio because of the dividend for the most part, as I mentioned, is the core reason why I'm adding ET over here in my portfolio in terms of energy. So let's go back and I'm going to be adding ET. That's not the alien. So energy transfer about 3,000 over here. And this is 296 units of stock. So 296, it's a cheap stock. We're going to open the trade and add ET and move on to the next stock in our portfolio. Hewlett Packard is going to be the next one with a 5% allocation. Is a company that I really like over here. Very cheap valuation, a 4.5 in PE and price to free cash flow. Net income that has been significantly increasing. The company is paying a high but safe dividend, increasing cash flow too. Very nicely significantly increasing free cash flow levels year over year. Of course, economic uncertainty and the fact that the company has some negative equity are some potential issues, but let's take a little bit of a closer look. I really like this one, and you will see that again it's solidly in the green everywhere. They have been buying back a ton of shares too, and you will see that they are paying a very hefty and safe dividend too. Great things to see here, and in terms of its valuation of HPQ, solidly in the green, very easily in the green. This is a company that definitely deserves a 5% in my portfolio. So it's going to be 5% allocation for HPQ over here, which is $5,000, and this is about 200 units of stock. Nicely circular, cyclical. Okay, so we're about, I think, 2 stocks or so till the end of the the generation of this portfolio here. So let's take a look at our next one. I wanted to add a little bit of UPS because it has been destroyed recently, and 3% allocation in my portfolio because of its cheap valuation, an increasing profit, high and safe dividend, increasing free cash flow, high return on equity too, but with some levels of debt. It's a growing company that I like, even though there is economic uncertainty. This is a little bit of a riskier one. The fact that it's paying a nice and safe dividend, a high one, it's nice enough for me to be wanting to get a little bit of a UPS over here. Again, realizing that there may be a little bit of a decline potentially here in the stock. But over the long run, I think this is a very nice addition to a long-term portfolio. So let's go back. So UPS here is a company that is, again, a company that I'm going to be buying for the dividend for the most part. Has a little bit of debt. The returns on equity are pretty nice because of that too. I mean, that helps with that in most situations. But you'll see that it's still growing, and it's a very well-known company. Still growing a ton, actually, if you actually factor the amount of revenue that they are generating. So this is nice for the company. And in terms of their valuation here, it's not the cheapest that you could get, but it's still relatively cheap, and its current price is sitting at 161. Our low estimates are 140, like the lowest ones. So for UPS, I'm gonna be adding 3% in my portfolio, again, mostly aiming towards getting this nice little dividend here, and also maybe get some growth out of this company actually in the long run too. Why not? And we're gonna be getting 19 shares over here, and we're gonna open the trade. And we're almost $5,000 short. Let's move on to our next one. Next one is going to be Upstart Holdings, and this one I would even want to get at a cheaper price, frankly. But I'm actually interested in adding a little bit. I don't want to be too greedy and maybe add a little bit in my portfolio with a 3% allocation, because there are some nice merits here for the company. It's trading at a 23 PE and 11 price to free cash flow, and it has been in my targets, basically in my list for a long while now. I was expecting it to drop more, but frankly I could add a little bit in my portfolio as well. I think it's already maybe there just a little bit. This is a company that it makes a lot more sense to be holding when the actual interest rates go down, frankly. But building a little bit of a position may not be a bad idea, since it has been kind of destroyed as well. The company's net income is also significantly increasing. This is a company that's growing a ton, has reasonable levels of debt, pretty much profitable already, which is another nice to see here for this company. And it's a great company. It's a risky one, of course. It has been diluting shareholders, as you would expect from a company of this sort, of course, issuing tons of shares. But let's take a closer look at it. Again, a riskier play, this one, Upstart, sitting at 21 almost. But you will see that it's doing rather nicely. And take a look at the key metrics here. The growth is insane for this company. And I like what I'm seeing. And the thing is, yeah, it has been diluting shareholders like crazy, especially when the stock price was high. Really diluting shareholders, as you can understand, but it has dropped a lot. And so at these price levels, I'd like to add a little bit to my portfolio. And you will see here, taking a look at our stock evaluation tool, that with these kinds of projections here, which could very easily happen, you'll see this is a very small company. This is still growing a ton. You'll see the 5-year average, and we're still in the green. So I think I like adding a little bit of this one even now, and I'm going to be adding 3% to my portfolio, UPST. Again, we're going to have a little bit of everything in this portfolio, some extra risk, some more dividends or less risk. So it's going to be, I don't know what this is. Did I go? Oh yeah, that's because I added $5,000 accidentally. So this one is going to be 3,000, not 5,000. So even the virtual one. So the units are going to be 143. And even the virtual one would ask you for money here. Okay, so we're gonna open the trade here for Upstart, and we have $1,800. This is actually a little bit less than what I would want. This has been affected by the other trades where I was actually averaging up, but I do have one more stock for which we're gonna be talking about. That last is going to be Tencent Music. It would have 2% of an allocation, like $2,000. Now it would have to have a little bit less. But it's trading at an 18 PE and an 8 price to free cash flow. The company's financials have been increasing nicely. Profitable, increasing profit, little debt, increasing free cash flow, a growing company too. Issues, of course, Chinese governance, supply chain issues, lockdowns, lower margins, the things that we know about China pretty much. But if we take a look at this company, you will see some nice things. So let's move to our tool. Understandably, this company has been really affected by China, but overall you will see that they are doing really nicely, and their metrics are fantastic over here. They're very nice, at least. Maybe not fantastic, but very nice. And it has dropped a lot based on what has been happening. I mean, they haven't been able to continue their massive growth, and you can kind of see it in the numbers. They were doing better than what they did last year. So I'm still using suppressed projections here, pretty much taking into heavy consideration what has happened, even though I think these are going to be better, frankly, in the next 5 years. But still, we are in the green for most of them, and it's only the low ones with the 7%, which hasn't even happened. Even last year, which was a bad year for the company, it was 9.7%. The 5-year average has been 60. So, as you can understand, the company has been growing a ton, and it has been affected by the recent crackdowns, the recent issues with China. This is why I'm going to be adding about 2% of TME in my portfolio, and it's going to be the last holding. It's going to be a little bit less, as you can see. Again, because we have been averaging up. So TME is going to be about $1,800. It has to. And we're going to be adding 431 units of stock. And we're going to open the trade and pretty much complete our portfolio here. So this is the portfolio that I wanted to make in this video. And of course, we can revisit it in the future, see how it's going to be doing in the next few months. Unluckily today, the stocks are going down. Again, the market is crashing once more, and so we're getting a little bit of a decline. But overall, I think in the next maybe year or two, or more even, I think this is a portfolio that's going to be doing nicely, and hopefully we can revisit it and see what's going to be happening. But I do thank you a lot for watching this video so far. This took a lot of time to make. Hopefully it was enjoyable for you. Hopefully it gives you some nice ideas. And if you did enjoy this one, please leave a like. That helps a ton, guys. And subscribe if you're not a subscriber already. And also, remember, you can get access to everything that you have seen, even the PowerPoint that I have been using. You will get access to it by becoming a Patreon. You will get access to our tool, of course, by becoming a Patreon here. You can do everything that I have done myself. You can do it with your stocks and pretty much follow through. And I hope, again, you enjoyed this one. I'll see you in the next one, a long one. Again, thank you for watching. I hope it was enjoyable for you, and I'll see you in the very next video, guys. Thank you again. See ya. Bye-bye.